Hi, I'm Vishnu Srinivas, and welcome to Hawkeye, a podcast featuring prominent business professionals and their views on topics impacting businesses and economies around the world. Make sure you rate, review, and subscribe. Joining me today is Tavi Costa. He is a partner and portfolio manager at Crescat Capital. Thanks so much for taking the time to speak with me today.
Thanks for having me.
So would you like to get into a short introduction about your background and your role?
Yeah, I am a partner and portfolio manager of Crescat Capital. Background, I was born and raised in Brazil. Been doing macro work for many years now, and it's been helping to develop most of the macro research that we have at Crescat Capital, and also helping to obviously manage the portfolio. A lot of what we do is really building models and internal models that help us to hopefully identify where we think we are in the business cycle and where we should be deploying capital and trying to identify big trends to invest over the long term. And so that's really the big goal of Crescat, and overlaying a lot of value principles to help us also manage capital.
Absolutely. And walk me through how you go about developing your process and what the key factors are that define it for you.
Well, I think it's important to understand that there is always a business cycle, and business cycles of globally, but also of each of different economies, and also different macro environments that we may be in, such as where I think we are in an inflationary environment, and really trying to understand how assets tend to perform during those times. And so it's using a lot of historical trends and trying to find analogs and times that actually rhyme with today's variables that we have, and sort of hopefully find that some sort of guidance through history that help us to invest money. But also, I would say those models that we use, they're focusing a lot of things. It's focusing on economic activity, where we are in terms of monetary and fiscal policies, and other things that are really, especially value. I mean, I think value principles that have been forgotten over the last 10 to 20 years, I think they're very useful to find out, especially where we should be investing in terms of industries and sectors. And also focusing on what I think are going to be the next fundamental factors that investors are going to care. So, for that, you need to think about where we are in terms of factors that worked in the past 10 to 20 years. An example would be revenues and top line growth. And now that you start seeing things getting a little more squeezed in terms of margins, profitability will start to become a priority for a lot of investors. And those are very long-term trends. I mean, I know I've been saying this for the next 1 to 2 years, but those are things that will develop for the very long term, because it's the same way a lot of companies were worried about top line growth and revenues in general over the last 10 to 20 years, because cost of capital is so low that allowed them to go after growth. Now we're going to go back to profitability like we saw, in other periods of history, like the 70s, when you had a lot of emphasis towards making money and margins. And so those are big trends, and they're gonna most likely benefit some particular industries that have better profitability and so forth. But the big story here is really trying to identify what I think are going to be macro trends that are going to do very well in the future. And there's no shortage of those today to be going after.
Definitely. And when you look at those macro trends, how do you avoid, or I guess bridge the gap between overreacting or underreacting to certain developments that arise in the economic environment?
That's a good question, because there's a lot of new narratives that emerge, especially when you have a great example has been the sell-off in commodities. Recently, you got a lot of new narratives emerging, such as recession. You shouldn't be investing in oil. You shouldn't be investing in copper, because in a recessionary environment, demand falls apart, and you shouldn't be buying those commodities as of now. But the big question is the long-term trend of those commodities. While you may change your weightings in terms of portfolio allocation during times that you think some of the cyclical commodities can get hurt, you always focusing on the long-term trends. You look at the capex trends, for instance, which is, I think it's what most of the commodity cycles are predicated on, is really long-term capex trends. Those take a very long time to reverse. And so the way I avoid that is really making sure the macro thesis is still intact, and understanding that narratives are going to emerge here and there, and there are going to be always new ways of twisting a story, because that's the way investments always or the investment world works. And I think, for instance, now, there's so many new narratives. Gold doesn't work on inflation, or gold is dead because crypto is going to take over. I mean, the list goes on and on. I mean, back in coming out of 2020, you got, why do you need to worry about inflation? Money velocity is so low. Money velocity is all that matters. And so you start going back to those narratives, and you really need to think about, what are those narratives that are happening today that we're going to look back and say, wow, how ridiculous was that? Yeah. And so, China is going to take over the world, and developed economies, euro. This is the end of the euro, and now it's the the dollar is the only currency that matters, and so forth. And I mean, I think there are merits to a lot of those thoughts, and there's always the other side of your argument of any investment you make. It's more of a question is of what is being priced in those assets that you think are going to perform accordingly. And if you think that the argument you have is strong enough that is not being priced that way. And I think that in a world where we have inflation and the micro, I would say the trifecta of macro imbalances, where you have the debt problem of the 40s with inflation of the 70s, and a valuation problem of the 1990s and late 20s, creates real political constraints for central banks and politicians in general to fight inflation over the long term. I'm not talking about interest rates rising to 4%. I'm talking about interest rates rising to 15%. Yeah. You can't do that. So that's a long-term play, right? I mean, if you are of that view, now you have a view about a lot of things. You have a view about emerging markets could perform, and how gold could perform in 5 to 10 years from now. Right. And that helps you to look back and say, well, how do I make money on gold? Is it really just buying gold? Maybe not. Maybe it's buying exploration assets, because most of the major companies are facing a supply cliff, and they're going to have to go through an M&A cycle. So, those thoughts are they're very in-depth thoughts, and they take a while. All of us go through a learning curve to develop those macro theses or themes that then you wanted to try to capitalize on them. And so that's sort of in a way how I try to think about the world.
Right. And you mentioned the oil sell-off development that's been happening over the past few weeks. Do you think this is then an impulsive reaction to immediate recession fears, or do you think it's like a strategic long-term play?
Well, I think a lot of things are being underplayed, like the amount of oil barrels that have been sold by strategic petroleum reserves by the government, U.S. government, about 27 million barrels being sold just in the last 30 days. Mm-hmm. That has to have an impact on oil. I mean, if anybody thinks it won't have, I mean, you're out of your mind. The question is, does that change the story of oil and energy over the long term? I think that the decline in oil prices, I should say, the decline in copper prices is even more important, because I know for a fact that supply for copper is very tight right now. And if you're seeing such a decline in copper prices, there is certainly a lot of issues being priced in about the implied demand of copper over the near future. That goes to show how, I think economic activity is on the brink of a collapse. And so I think that's what reflects a sell-off that we're seeing now. Is it a great opportunity to be buying into businesses that are related to those underlying assets like copper, oil, silver, gold over time, and accumulating those assets? I think so, because I think over the long term, you're going to see a shift towards continuation of investors looking for tangible assets. I think commodities, we're at the beginning of a commodities bull market. We've seen maybe the very first inning of that since the election, since 2020 all the way to now. And now I think we're going to see, there are going to be pullbacks and maybe even bear markets in between, like we've seen now. but this is the beginning of a cycle, the same way we saw the cycle of software and so forth. So
Right.
you don't want to be too caught up on those narratives. I mean, it's, opportunities are like that, and they're painful. You go through moments of pullbacks, and you just want to be adding to your position during those times, and ignoring the noise.
Exactly. I think with any kind of cycle, there's going to be a lot of volatility and a lot of external noise that you kind of have to tune out. And to be clear, you do believe we are in the midst of a recession, or at least an economic slowdown, right?
Well, it depends, because in real terms, I think we are. In other words, I don't think nominal growth is growing as fast as inflation is. And so if you look at inflation rates versus, which is technically how they calculate recessions, is in real terms. We've had a decline in real GDP back in the first quarter.
Yep.
Most likely we're seeing the same now, and not because of nominal growth has been declining, but because inflation is growing faster than nominal. Now, I do think we're going to see nominal growth contracting. And that's because, just go back to what we saw, just an example, just go back to before the pandemic issues. There was no labor shortage, right? Labor was fine. We got an economy growing with enough folks working. There was no shortage in companies looking for folks to work for them to really help them with the boost in growth in general. But since the pandemic, we saw this boost of government policies, from monetary to fiscal, that literally gave money to people to spend. So consumption, and you saw saving rates go up to 35% of disposable income, which is now at 4%. But back then, it was a level that we've never seen throughout history. And we saw a depletion of savings of about $5 trillion entering the economy. So imagine at that time, now it's a little larger, but GDP at about 20 trillion, and you got 1/4 of GDP coming into from consumers spending money. What do you think is going to happen to economic activity? It's going to, it's going to go to levels we've never seen throughout history. And that's precisely what we saw in 2021. So you saw economic activity going crazy at a time when labor markets are, seeing issues. And so obviously we saw labor shortages, but now what is next here? That's what matters. That's looking in hindsight. What matters now is that most likely that economic growth that we saw in 2021 is completely unsustainable, unless they say, you know what, screw inflation. We're going to give money to the consumer. We're going to print money again, and we're going to give back to see saving rates increase again. If that happens, I'll change my view, but that's not what's happening. And so most likely you're going to see economic growth really contract. Now, if you look at job openings right now at record levels, which is still reflecting what we saw in 2021. It's a lagging indicator. And so at some point, in the scary part is that policymakers are looking at this lagging indicators to make assumptions of the future here. And so I'm very worried about that, because we're aggressively tightening at a time when I think we're actually about to see a contraction of earnings and economic activity, which should only exacerbate those contractions and make things even worse. So I think that's where we are right now. We're about to see labor markets deteriorate, and things, but starts with economic activity and starts with corporate earnings declining. So that's where we are right now.
Yeah, definitely. And when you see the pricing in today's era, we obviously see a lot of debate over comparisons to the 70s inflation. And obviously no two eras can be exactly alike. But when you look at the historical trends, do you see more similarities than differences in terms of pricing?
Well, I think there are a lot of similarities with the wages and salaries growth spiral that we had back then, which is real what's happening here, even though in real terms is very bad, because companies are not paying enough wages and salaries growth relative to where inflation is growing. But regardless, in nominal terms, we're seeing a growth in salaries and wages that we have not seen all the way back to the 70s. Some people think it's not, it's transitory. I don't think it's transitory. I think it's just like what we saw in the 70s. Those are very, very difficult trends to reverse. And what that means is that we're probably going to see a contraction of earnings over time, because there's a lot of room for companies to be paying higher wages and salaries. That's one of the reasons why they've been so profitable over the last 2 decades or so. And we've seen, you look at a chart of profitability of corporate profits, they've been surging over the last decades or so. And so there are risks to that, because I think wages and salaries will be one of the components, and you have costs of materials in general are going to be higher, and then the cost of capital with interest rates should also squeeze. So though the wages and salaries growth is very similar to the 70s, what is perhaps different is that in the 70s there was some sort of sense, general sense from policymakers about fiscal stimulus, meaning, they knew the fiscal stimulus was creating the inflationary problem. Where today, I mean, there's been a total denial from policymakers that fiscal stimulus has been causing inflation, which is scary. We're still seeing fiscal spending to levels that we haven't seen really throughout history. And in my opinion, that is one of the big problems with structural inflation issues. Let's see, other issues was in the 70s was more related to energy prices in general that was causing a lot of the inflation issues with the oil embargo that happened in the middle part of the 70s. Today is really a lot broader, right? Because you have issues with agricultural commodities, you have energy being a much bigger problem with the Green Revolution that did not exist in the 70s. There was no political effort against companies to explore, develop, and produce natural resources. Today we have that. And so that's a difference. I would say the long-term declining CapEx trends are much more severe than what we saw back in the 70s. And the biggest difference with the 70s to today is we didn't have the debt problem, and the valuation problem wasn't an issue either. So 73, 74, when inflation was growing to close to double digits like it is today, it took the Fed to completely crush the equity markets by about 48% in the S&P 500 to now start seeing a declining trend in CPI at that time. Yeah. And so that gives you a sense where we are in perspective of how much more of a decline in demand we need to see in order to stop inflation from growing. But evaluation at that time, when markets declined 48%, we're nowhere close to where they are today. So those are all the big differences with the 70s, in my opinion. I think it's a lot more severe than the 70s.
Right. Yeah. Because I think there's a lot of different factors that are driving the current situation today than maybe in the 70s. Where I want to shift to next is looking at commodities, because ever since like inflation has really taken off, gold and silver have been seen as popular kind of investments in terms of being safe havens. Do you still see this to be the case?
Yeah, I think gold is still going to be, I think we're in the midst of a lot of issues globally, especially in regards to what's going on with central banks buying gold, having to buy gold. And we'll see that trend to probably accelerate over the years, just because of the monetary crisis most countries are facing, and the need to improve the quality of their international reserves. Places like Japan, Europe, and so forth are all facing a lot of pressure to instead of owning treasuries in order to improve the credibility of their reserves, they're going to have to own things like gold. And so at some point, we're going to see that trend of accumulation of things like precious metals, and so which should be driving the demand. That's why gold is such a monetary metal alternative to what we're seeing, and I think we're gonna go there again. So this depreciation of gold relative to the dollar is real. It's happening recently, but I think it's completely unsustainable, and that's why you're seeing gold prices in foreign currencies increasing. I think it's going to be a matter of time until we see a big upward move in gold prices for the next 5 to 10 years. Which, if you are of that view, and if you have a very strong view on that, you really need to think about how do you invest in that environment, right? Because if you think gold is going to be higher 5 to 10 years from now, not lower, then it gives you an opportunity to be taking more risk in other parts of the gold mining industry, not necessarily royalties and producers, but you can go down and search for inefficiencies that are current in place, that you can purchase companies that can do very well in that environment with a lot of leverage to gold prices, not from a debt perspective. And so to me, that's the way I see it. It's an incredible opportunity. And I think we're going to look back 5, 10 years from now, and it's going to look very obvious. And unfortunately, not a lot of people are, taking advantage of what's happening.
Definitely. And beyond the short term, how do you see other commodities playing out in the future in terms of like energy and agriculture?
Energy transition is going to be a real macro trend. So we're going to go through, critical metals that are likely to be, beat up over the years, meaning are probably going to go through a cycle too, a bullish cycle. Copper being one of them, but you got cobalt, you have nickel, and so forth. All those metals should do very well. The whole periodic table, should do very well, especially the ones that have the supply constraints as part of their thesis. And there are other things that are not as bullish, just because even though we may see political shift towards that, I see the demand aspect, but I don't see the supply aspect. Call it uranium, things like that. I think that the jury is still out. I mean, you got all this political effort perhaps shifting towards benefiting those developments, but you don't have the same supply constraints. I mean, there's enough uranium in the world today, right? I mean, it's not like gold or silver. Let's call silver where it fits into solar panels and green revolution and monetary metal, but we don't have enough silver. And so, to me, that's a much more attractive proposition for investing than something like uranium. So that's why allocation needs to be adjusted accordingly.
Exactly.
And I know for a fact that mining is a cycle that takes a long time. And so it will all, I think will be a long-term cycle. Now, agricultural commodities, are also interesting. They also do very well. They did very well back in the 70s and other inflationary environments. But I think you want to be aware that inventories and so forth, they will change much quicker. It doesn't require the same capital intensive situation that happens in mining space. And so, and energy might be another one that we're currently invested. We got about 20% of our portfolio, global macro portfolio, in energy that we think is going to do very well over the next few years. And we can change our view on that when we see supply situation change, if ever changes. And if that happens, I'll change my view. But I think we're very far away from that.
Yeah, I think supply is just the deciding factor in all these types of investments. What I want to touch on last is emerging markets, because they are obviously critical to a lot of portfolios in global macro. Do the recent events in Sri Lanka raise any concerns for you about how other emerging markets might treat debt in terms of defaulting?
Well, look, I think growing up in Brazil, I've seen a lot of how inflation is a current theme, is a recurrent theme in emerging markets. It's not a new thing. I mean, it's a new thing for developed economies because we haven't seen for so many years that market participants, investors, and the population has just haven't had to deal with that for many decades. And so for emerging markets, we've seen those issues being part of their macro environment for many decades. And I think the biggest thing has to do with a lot of policy making that wants to depreciate currency to improve exports. We see this across emerging markets all the time. And usually when you have those deep moments of inflationary problems, you see big changes in political environment. So, in Brazil, that happened in 2015, 2014. It was, we got an impeachment of the president at the time. And so, some people may say, well, that was a political event. It wasn't a political event. It was an economic event caused by inflation that created a lot of political, or I should say social unrest that caused the political shift. It's the same thing happening in a lot of those countries that, you may twist it as, the trigger is, the certain president was caught doing something wrong, but that's not really what's causing it. It's a much more of an economic event than a political event. And so we're going to see that across the world. The global economy cannot sustain, an upward rising in interest rates, number one, especially from developed economies, but also cannot sustain an upward move in the dollar. Okay, so that's going to be a problem, right? At some point, we're going to have to see some coordination from central banks to reduce the appreciation of the dollar that we're seeing recently, because it's just unsustainable. And so, in my opinion, if you were of that view, and you were of the view that gold is going to do very well versus other currencies, I think this is very similar to early 2000s when, we did see emerging markets get caught up with, a recession during that time with the tech bust, but they didn't get caught up to the same degree. And the other point that is even more important is that coming out of that recession, emerging markets led the way to the upside. I think we're going to see that. And so I'm very focused on, yeah, sure, I think that there's going to be a decline in economic activity. We're going to get crushed in terms of earnings and so forth. But there's going to be a time here that's going to flip to the upside. And when there's blue sky economically, you want to be allocating capital towards emerging markets that are commodity-led economies. And Brazil is going to play a big role there, in my opinion. And that's why I'm so focused into that, because I've never been bullish on Brazil. And I understand the political and the economic pressure we may see in the next, 6-9 months or so. But after that, I think it's going to be blue sky for most of those countries. And I think it's important to be already thinking about how you're going to take advantage of that.
Yeah, that's definitely a really key insight. Awesome stuff, Tavi. Really appreciate the time. Thanks so much.
Thanks for having me. I appreciate that.